Is this all a bubble and it's about to burst? Or is the very opposite true? And we're standing at the start of a generational bull run powered by AI that was just invented a few years ago and is going to take a decade to build out? Well, the answer to this is something that you're going to have to determine yourself because none of these freaking analysts know. I mean, many of these people are just people who had TDS and didn't buy in when the market corrected this year. I mean, you're probably too afraid to buy in then too. So the answer to this question is something that you have to figure out or potentially miss out on the greatest opportunity, the generational opportunity that I say is, what a time to be alive it is. I see this as a fourth industrial revolution. It seems so obvious to me. I mean, we had steam power, then electricity, then computerization, and now we've just invented AI. And unless it kills us all, unless it literally wipes us out, then everything is going to be transformed to such an incredible degree that the people who are saying this is a bubble, looking at the early stage of this technology and claiming it's all a bubble, are like people in 1990 holding a Nintendo Game Boy and saying, this is the peak, we've peaked, and not realizing that the iPhone 17 would come along. I mean, it seems so obvious to me, but truly nobody knows exactly what the market is going to do. So to that end, there was a good discussion last night on Stephen Fiorillo's channel. Go and subscribe. I am naturally averse to playing other people's videos at this point. In my little YouTube career, I like to be a little fish that doesn't pop his head up above the water anymore. Because when you play somebody else's videos, if YouTube alerts them that you've done that, and they might not like it. I like to live in a dark forest now. But this was a good discussion last night, so I'll play a little bit of it. These are two investors forward-looking and saying, we've had great returns in the market. Can this continue? And what's to come? So I'll link to this in the description. Go and subscribe to Stephen Fiorillo. And don't copyright strike me, bro.
I mean, look, if we get 4.5% growth, we're going higher. So, well, that's the other thing. If you think if Trump,
if you need full dentures but can't deal with the endless expensive dentist visits,
bro, I've got an advert. Fucking hell, Stephen.
Promising a golden age, and it ends up becoming a real golden age.
And let's not forget who's calling the shots on technology right now. This is a much different administration than other administrations that we've seen. Think about who he surrounded himself with Bissett, Sachs. I mean, I'm not convinced the technology is not going to do good over the next couple of years. We may have a correction, but I think it ultimately is going up.
I think it's hard to be bearish technology. These earnings that we're seeing, it makes it really hard to be bearish tech.
It's really hard to be bearish tech.
So it's just, at what point does NVIDIA add another couple trillion next year?
Amit, they're not expensive companies.
I'm not saying they're expensive. I'm saying, do you think the market has the I guess excitement to give them even more than they've already given them? I don't know. In 2030, you give them another couple trillion.
Sure, because the market's forward looking. Look, I know that you hate when I do this. And I'm going to take Palantir out of it, so I'm not disrespecting Palantir, okay? I'm going to take them out of it. I mean, look at Meta, all right? Are we saying that paying 26 times for Meta this year earnings and 21 times 2027 is an expensive company? Are we saying 25 times for Alphabet and 21 times 2027 is expensive? I mean, from Meta, Alphabet, Amazon, Microsoft, NVIDIA, Apple, and Broadcom, they're all under 30 times forward earnings for 2027. That's not an expensive market.
No, I don't disagree.
Especially when you're seeing this type of growth. I mean, look at Broadcom. Broadcom's trading at 51 times this year, but they have 75% forward growth, and that's not including where this started or where the EPS started this year. I mean, it's just there's so much growth on the horizon that the street is factoring in that this does not look expensive, especially when I put Walmart in here. Because we all know how this is going to look if I put Walmart and Costco. So if all these companies are cheaper on an earnings basis than Walmart and Costco, are we in a market that's expensive?
No. I do not think we're in a market that's expensive. I also think, given the earnings growth I'm seeing already over the past couple of weeks, you can justify and validate the multiple on the S&P 500. And when you look at the earnings growth going into 2026, as you showed on that chart, you can say, yeah, Meta's not expensive. Google's not expensive. The broader question is, does the market have the fever to be able to say, hey, we are just going to keep making sure the rich get richer? And, that was, you and me kind of had the same thesis end of 24, which is that's going to happen in 25. And we had a little hiccup, but that's what has ended up happening.
But it's not even the rich getting richer because so many more people are exposed to stocks these days, even if it's just through 401ks. But look at this. This is and I'll zoom out first. This is the S&P 500 PE ratio historical chart, okay?
Yeah.
We're nowhere near where we were in 2020 and 2021. When you got to almost 40. We're 28. Is it high?
It's not
a little bit
well,
on an aggregate, but I don't know. It's not crazy.
No, 21 was stupid because there was no earnings growth. So it's just not, it's not even comparable. Yeah.
Right.
2021 was dumb. So I agree with you. Your point about people being more exposed to the market is also a really good point. As more and more people get in, like they're going to buy the companies they know, like Google, like Amazon.
And let me make this point real quick. There's more money coming into the market than ever before because pensions are dead. They become privatized with 401ks and 403bs. So every 2 weeks, people that are saving for retirement, the main way that they're probably saving for normal people is through having money taken out of their paycheck and put into their 401 or 403b. And what are the most common investments there? Total market funds, index funds, and target date funds. Most companies, from people that I know that have these types of plans, the first time they log in, it's in a target date fund based on their age. What are the biggest holdings of these funds? The freaking Mag 7 are all in the top 10, mostly. Unless you're in a target date fund that is like a 2030 fund because they've already started the sliding scale toward bonds. More money comes into the market every 2 weeks, more than ever before because less and less companies have company pensions. So there's also nowhere else to put money. Think about that. Most people don't own real estate as an investment. Most people are not out there flipping houses or buying rental properties. Most people get their investments from the market. So
you are preaching to the choir.
I'm not seeing a scenario where money coming into the market is going to stop. I mean, think about this. Anybody who's on auto in the chat, just say yes or no to this question. When April happened and the market went haywire down to 48.50, did you stop putting money in the market? Did it go into cash in your account? Or did you just keep buying whatever you were invested in?
I kept buying.
We had one person.
All right, I've got another advert. We'll cut it there. Look, go and subscribe to Stephen Furilla. I'll leave the link in the description to exactly that time-stamped conversation. I think you should listen to all of it if you're struggling with this question. I mean, it's what Tom Lee says. It's Tom Lee's, also his opinion. He was on Anthony Pompliano's show today, 14 hours ago. It's the point that he keeps making too. Yeah.
I think people then say, well, there's a generalized stocks are expensive problem. And because I was just in Latin America and that's what a lot of the pension clients said. But to me, the problem people have is that stocks are trying to discount the future. And AI is not only a labor replacement, so we can calculate, job replacement, and that's a use case. But then there's this agentic and super intelligence potential, which creates productivity. So how do we discount that in the stock prices today? I actually think stocks are still cheap. And I know Jensen was in New York recently, met with some analysts, and I think a lot of the takeaways people had is that in the AI world, companies, enterprises that are spending are starting to see payoff on the AI spend, which means spending is picking up. I actually think AI spending is actually accelerating.
So I'll link to that one too. You have to come to this decision for yourself. Otherwise, you'll be waiting for something that might never come. I mean, did you invest in April? Okay, when the market corrected, did you invest them? Yes, there'll be no. Here's look. Hate to break it to you, already invested. If you just think like I do, you're just bullish, and this is only going up. It won't. It'll go up. It'll go down. There's froth in the market. Some things will get too close to the sun, be burned, and come crashing down. But in general, and like Amit and Stephen were saying in that podcast, the big players are here for the next decade. They're all in a race to build out this AI. So, look, this is a decision you've got to come to. Go and watch that discussion that those two guys were having on Stephen Fiorillo's channel. If you rewind something like 20 minutes, there was even more discussion about like companies like Hood and Palantir that have run up, that have done a double this year or more, and as investors in those companies, they were asking the honest questions: what can we see next year? I mean, can we even if the market continues to go up, can we expect this from these companies? These valuations are excessive. What are we going to do? This is all good forward-looking discussion that you should have as an investor. Always remember, you should be prepared to lose all of the money that you invest. I'm not a financial advisor. This is not financial advice. I'm somebody who accepts a lot of risk, because I think if I make a lot of mistakes right now, I've got decades ahead where I can not make them again. But I'd rather take the chance personally, in my opinion, with my risk appetite and my current situation. I'd rather take the risk and not miss out on this potentially generational opportunity. Thank you for watching. I appreciate you.